Hey, welcome back, y'all. Video number 2 on doing your own investing. So this time I'm just going to talk about you have your account all set up, you're ready to choose your first investment. So whether you're in a Roth IRA or an educational savings account, ESA, same thing. So like I said in the last video, you want to buy a mutual fund. I'm going to tell you how to choose a good mutual fund. If you, whatever company you're using, your online brokerage firm, they will have a what's it called? A screener. So you can type in, select certain things you're looking for. It will screen thousands of mutual funds and bring up the top picks. And from there, you pick what mutual fund you want to invest in. How do you know which one to choose? Well, let's go over that. Okay, so here's just several things I look at when I'm looking at a mutual fund. So if you bring up, and usually every mutual fund has a symbol like 5 letters or so like A, B, C, D, E. And so let's say you're looking at mutual fund A, B, C, D, E. How do you know if it's a good one to invest in? The first thing I usually do is I get on Morningstar.com, and they're a website to give you every piece of information you'd really want to know about a mutual fund to be able to invest it. I will check it there, and I will check it on whatever website I'm using that I'm actually investing in. I look at it on both, and I see if the numbers are lining up and if they're consistent between websites. Sometimes you'll see a little discrepancy, and I don't really worry about it. But on Morningstar, one thing I like is they give every mutual fund a rating, like 3-star, 4-star, 5-star. Some mutual funds I've looked at, all the criteria I look at, and I really like it, and Morningstar only gives it like a 3-star rating. So I don't just look at the star rating. If something gets a 3-star, but it looks really good to me otherwise, I'm going to go ahead and get it if I love it. Obviously, if a Morningstar gives it a 4 or 5-star, then that's cool too. I look at that because I care. Like, I care what they think and how they've rated it. They're a leading website on stocks and mutual funds. Okay, the next thing I'll look at is the inception date. When did this mutual fund get started? If it's a brand new mutual fund, it started a year ago, 2 years ago, 3 years ago, I just write it off. I don't even go there. I want to look for a mutual fund that's been around 10 or 15 years. It has a good long-term track record. I don't want a new one. I don't want to take that risk. I want to pick something that's been proven so far. Then I'm going to look at fees. Fees can really cut into your long-term investment. So there's a few different types of fees. Basically, there's the first fee I really make sure to look at is there's fees with a load, either a front-end load or a back-end load, or no load. So you have 3 options there. Front-end load means when you make the purchase, you automatically pay them 6% of what you're putting in. They take that off the top. A back-end load is when you go to sell, they're going to take money out. And a no-load fund just has the built-in fees for having the fund, but they don't charge you up front. They don't charge you at the end. Dave Ramsey doesn't necessarily recommend those. He thinks that the ones that are better performers are the ones that you do pay a load on. I haven't found that to be true, but I love Dave Ramsey and I do follow his advice, but I haven't found that to be true. I found lots of funds that are no load funds, so I'm not paying on the front or back, that perform great, that are great. So I usually purchase no load funds because why pay the extra? If I had to choose between a fund that's going to perform really well, but I had to pay the fees up front, or a fund that's not going to perform well, but I don't have to pay up front, then I'll pick the one that performs well. But I think there are thousands of funds to choose from. So there's options to choose no-load funds that still perform well. Next thing I look at is the manager tenure. If it has been managed by the same guy for the last 10 years and it's performed well, I like that. If they just got a brand new manager last year, I'm gonna wait on that one. I want to wait and see what he does with it, and if it ends up performing well. Then the next thing, you'll see these graphs on Morningstar, which are really cool and easy to look at. And there's basically 3 mutual funds you can buy: small cap, mid cap, and large cap. Small cap is small companies, maybe new technology companies or smaller, probably like, I'm trying to think of a smaller company. I don't know. I used to think of Radio Shack, but I think they're out of business now. But anyway, small guys like that are going to be small cap. Then you have mid cap, like mid-sized companies. And then you have large cap companies like Google, Walmart, Amazon. Huge companies, and they even, like the Morningstar chart will even show you if they're giant companies or under small, it'll even show you if they're micro companies. So really, if you go micro, small, mid, large, and giant, basically just small, mid, large, but you'll see giant, micro on there. And you want to diversify. So when you very first get started and you pick your very first fund, I recommend picking a large cap, like a big company that you know they've already grown a ton. It's not super risky for you to invest in. They're obviously going to do well. They are well established. So I would choose a large cap to get started. Once you have chosen a large cap and you've invested in it and you're getting your feet wet and you feel good about it and you're ready to pick another mutual fund, then try to pick a mid cap. And then once you feel good about that and you're cruising along, then try a small cap. And so you want to get diversified in all small, mid, large. But to get started, just start with the large. It's easy. Okay. And then I look to see if that fund is open to new investors. A lot of times you'll find a great fund, but they're not open to new investors. So it's not even open to you, so just pass it up. So just take a look at that before you spend 30 minutes looking at the fund, see if it's even a fund you're allowed to even invest in. And if it is open to new investors, a lot of them have a minimal amount you have to put in. So let's say it's open to new investors, but you have to put in $2,000. Well, you wanted to start out with like $100. So obviously that one's not going to work either. So just write it off and go on to the next one. Thousands of mutual funds to choose from. You don't have, if something doesn't meet your criteria, it's out. Boom. Go on to the next one. So if it's open to new investors and you're brand new, pick one that's open for like $100. So if it says minimum's 100, that's doable. That's good. And then I want to look at the performance, and that's probably the main deciding factor, right? We all want our mutual funds to perform well. We want to be able to have enough money at retirement. So I look at the 10-year track record and the 15-year track record. If it's been around that long, hopefully maybe it has at least 10 years. I don't even look at the 1-year or 5-year track record. I don't even care how it's done over just one visa year or even 5 years. I'm looking long term. So I'm going to look at the 10-year, 15-year. Some mutual funds have been around 20, 25 years. I'll look at those records as well and see if it's performed well. And when you run a screener and you put in all your criteria you want, you can, once they give you your list, then you can click on performance and you can sort them from best performing down to least. So then at least you're not wasting a ton of time. You can start right at the top and start looking at the first 10 on the list and see if any of those meet all your criteria that you're looking for. And so go with the top performers. Dave Ramsey says you average about 10% over time. So looking for a number around 10 is a good starting point. If you find some that are performing at 12% over 10 to 15 years, then that sounds great. If there's some that are 10 or 15 year funds that are performing like 4% or 6%, just forget those. Just write them off and go on to the next one. Okay, and then you want to look at the turnover, and you'll see it. It'll be listed on your screener, but it'll say turnover. Turnover means how often is this manager selling and buying, selling and buying, selling and buying. So is he getting rid of, Walmart and Hobby Lobby and all these, and then buying something new the next day? If he's constantly turning over the portfolio, then that's not very steady. It's volatile, risky, and I don't buy those. So I want to look over. I want to look for a company that buys and holds. Buy it, hold on to it, ride it out. Don't just always be selling and buying. And there's usually more fees when the manager sells and buys. So look for one. I forget. I think I usually look for, I didn't write this down, a turnover that's like 20% or less. So he turns over about 20% of the portfolio per year, probably, I think it is. Any more than that, he's buying and selling too much, and it's just going to cost you more fees. Okay, and then I look to see if it's diversified. I look at the list of companies that it invests in. So I look at like the top, it usually lists like at least the first 10 of them, the ones that it invests in the most. I look at those companies and I say, okay, is it diversified in different areas of the market? And I look at it and say, do I have a problem with any of these companies? Are any of these companies problems that I ethically have a problem with? Are they supporting stuff that I don't agree with? So if they are, they're out. So pick ones that you don't have an ethical problem with, and then just make sure they're diversified companies. You don't want them to all be in, pharma or all in technology. You don't want it all in technology. You want to be diversified. Okay, and then check the cash reserves that are listed. If the manager is holding on to a lot of cash, that means he's not investing that cash. And you want the money invested and actually growing with the market. If he's holding on to cash, you could do that yourself and make a little measly interest in the bank. So you don't want him to just be holding on to 20% cash. Invest that 20%, sir. Get it going. I don't want cash sitting around. That's why I'm investing it instead of just leaving it sit. So I would say it needs to be under 8% cash reserves. Okay, and then make sure you're not buying in one sector of the market. Like, don't just buy a fund that's in gold or a fund that's just in real estate. Make sure it's diversified. You don't want to be buying, and then also you want to buy, like once you get your large cap going, and maybe once you get a mid or a small cap going, you also want to be diversified in investing internationally. You don't want everything you're invested in to be U.S. So you want to pick an international fund. When you pick an international fund, you don't want it to be just one company. You don't want it to be just China. Find an international fund that's covering multiple markets. So you're being well diversified by picking a mutual fund instead of individual stock. Within your diversified mutual fund, you want to be diversified even more. The more you diversify, the less risky it is. The more you put your money into one basket, the more risk you're taking. Okay. Also, when you're putting money, like let's say you have like the full amount to invest in your Roth IRA, you have $5,500 sitting around, you're ready to dump it all into a retirement account. Don't do that. You want to do dollar cost averaging. So dollar cost averaging is where you put in a little bit every month for like 12 months. So if you have $5,500, divide that by 12 and put in that much every month. Because if you put it all in at once, you might be putting it in when the market is the most high. So you're buying the mutual funds at a high price. And then if the market doesn't go up much more, you bought high, so you're not going to be making that much money off of it. So dollar cost averaging, sometimes you'll be buying high and sometimes you'll be buying low. So you'll get like a nice medium price there. So it's good to dollar cost average. If you don't want to go through and pick mutual funds based on all those criteria I just listed, you could just buy an index fund. An index fund is just a fund that tracks like the S&P 500. It just tracks, it's just an index. So it's just following what the market does. Whatever the market does, that fund is doing. When it goes up, when the market goes up, your fund's going up. When the market goes down, your fund's going down. And so those are easy and they perform average. So they're a fine option if you don't want to sit there and go through and pick a mutual fund. And then also you want to buy and hold. Once you buy a mutual fund and screen it well, make sure it's one you really want, then hold on to it. You don't want to be buying and selling and buying and selling. You're going to have less fees if you buy and hold. And you don't want to be checking your account all the time and saying, oh, how's my investing doing today? How's it doing today? How's it doing tomorrow? How's it doing? No. Barely check it, really. I check ours like once a year. Once I've picked a good one that I feel solid about, I don't want to be all hyper about it and crazy and getting feelings like, oh, I should sell, oh, I should buy, oh, no, just let it ride. Once you buy one, let it ride. Now, if it's been like 3 to 5 years and that fund has not done well, then sell it and get a new one. But don't just sell it within that first year just because you think it had a low time. I mean, it will probably pull back up if you picked a good one with a good track record anyway. I have sold ones that hadn't performed well, but they weren't ones I picked. They were ones the professional picked back when we had a professional, and I finally got fed up with her fees. And then once I learned how to look at the funds myself, I was like, she has us in these horrible performing funds because they made her a lot of money up front. I was upset about it because she wasn't doing what was in my best interest. She was doing what was in her best interest. So I sold off her funds because they weren't performing well. Okay. I think this is my final thing. I don't know. I tend to ramble. But the last thing is once you start buying funds, you say, well, how many mutual funds do I need? You just start with 1, advance to 2, advance to 3, maybe do 5 to 6 over time. You could even do up to a dozen, and that's fine. However many you can manage. And sometimes I just see a new one that I like, and I'm like, ooh, that one's got good manager tenure, good fees. It was founded, 15 years ago. It's got a good Morningstar rating, good turnover. It's diversified. I agree with the ethics. It's a good mutual fund. I really like it. But I already have 10. Well, that's fine. Just buy it. It's fine. You're doing your own thing. You can enjoy it, and you can have your little favorite funds that you just enjoy doing, right? If we don't enjoy it, then why put ourselves through the misery? So, okay, I think I covered most everything that I do. There is definitely a lot more to learn. I don't know it all. There's more ratios and things you can look into and be very, very specific about this and try to read the market and everything. I don't do any of that. This is just the basics, and this is what I do. And I'm not saying that it's the best for you. You have to evaluate that. All right, thanks, guys. Have a great day.